Ever wondered how the stock market works? It's not as complicated as it seems. Picture the stock market as a bustling public marketplace. But instead of fruits, vegetables, or other goods, what's being bought and sold are shares. Now, you might be thinking, what exactly are these shares? Well, simply put, shares are like tiny slices of a company. When you purchase shares, you're essentially buying a miniature portion of that company, making you a part owner, so to speak. This marketplace, where the trading of these shares happens, is what we call the stock market. In this market, the shares of publicly held companies are regularly bought, sold, and even issued. So, in essence, the stock market is a hub where shares of companies are traded. Now that we know what a stock market is, let's explore how it operates. When a company decides to raise funds, it can go public through a process called an initial public offering, or IPO. This allows the company to sell shares to the public, transforming from a private entity into a publicly traded one. It's a bit like opening the doors of a private club to everyone. Now, once these shares are listed on a stock exchange, their prices begin to fluctuate. This is where supply and demand come into play. If a company is performing well and shows promise, more people want to buy its shares. This demand pushes the price up. On the contrary, if a company is underperforming or faces negative prospects, shareholders may want to sell their shares. This increase in supply with less demand drives the price down. Hence, the performance of a company directly influences its share price. What facilitates these transactions? Enter stock exchanges. These are the pillars that hold up the stock market. They are the stage where the drama of buying and selling stocks unfolds. Stock exchanges provide a regulated and convenient venue for companies to list their stocks and for investors to trade these stocks. The best-known stock exchanges, the New York Stock Exchange and the NASDAQ, are like bustling marketplaces. Only instead of fruits and vegetables, the goods exchanged here are shares of companies. The traders from all walks of life are united by a common goal: to profit from their investments. But these exchanges do more than just facilitate transactions. They also impose rules and regulations to ensure fair trading. They provide the necessary information about listed companies, helping investors make informed decisions. In essence, they are the guardians of transparency and fairness in the stock market. Stock exchanges provide a platform for the smooth operation of the stock market. Who participates in the stock market? Investors and traders primarily. Now you might wonder, aren't they the same? Not quite. They differ in their approach, strategy, and the time they spend in the market. Investors are the marathon runners of the stock market. They buy stocks with a long-term perspective. They place their bets on companies they believe will grow over time. Their strategy is to hold onto these stocks through market ups and downs, banking on the company's growth potential. Traders, in contrast, are the sprinters. They're here for a quick dash. They buy and sell stocks within a short time frame, sometimes within a single day. Their goal is to capitalize on short-term market fluctuations. They're not necessarily interested in the company's long-term prospects. Whether you choose to be an investor or a trader depends on your financial goals and risk tolerance. It's all about finding the strategy that works best for you. What factors influence stock prices? Let's delve into that. Stock prices are like a barometer, reflecting a company's financial health and future prospects. A company doing well, showing profitable results, or releasing a promising new product can see its stock price rise. Conversely, a company facing financial difficulties or a scandal can see its stock price plummet. However, it's not just about individual companies. Broader economic conditions like interest rates, inflation, and GDP growth also sway stock prices. Even global events, from political elections to natural disasters, can cause ripples in the stock market. Now, investing in the stock market can be a powerful wealth-building tool, but it's also a venture that comes with risks. Market volatility can lead to significant losses, and even the most promising companies can falter. While the stock market presents opportunities for wealth creation, it's important to understand the associated risks. Do you have any questions or thoughts on the stock market? Comment below.